Welcome to the Deep Dive. We're the show that really tries to cut through the static and get you the insights that actually matter.
Mm-hmm.
Today, we're taking that deep dive into D-Wave Quantum Inc. That's ticker QBTS. We're looking at their Q2 2025 earnings analysis.
Right.
Now, you know how earnings reports can sometimes feel like this, massive puzzle, loads of numbers, and they don't always tell the whole story right away.
Definitely not at first glance.
Exactly. So our mission today is really to help you cut through that noise, understand what's really driving D-Wave's performance, and get to those core insights. We'll be using a structured framework to look at their press release, mixing in company data with what the market was expecting.
Yeah.
Think of it as, your shortcut to actually being well-informed about D-Wave's latest numbers without getting totally lost in the details.
Okay.
Okay, let's unpack this.
And that structured approach is, well, it's just invaluable, isn't it, for analyzing any company, really, but especially one like D-Wave in such a, complex field. Right. It helps you move past just the headlines, right, to really get a feel for the financial health and the strategy. And D-Wave's Q2 report, well, it's a fascinating case study. Appearances can be deceiving sometimes. Perfect for a deep dive like this.
Absolutely. So let's kick things off now for slide 1, the at-a-glance scorecard.
Okay.
This is where we get that, immediate top-level summary. And right off the bat, it was, a mixed picture.
Mm-hmm. Mix is a good word for it.
Looking at those immediate headline results, D-Wave actually delivered a revenue beat. They reported total revenue of $3.1 million. That beat the consensus analyst estimate, which is around $2.54 million.
Yeah, pretty significantly. That's a strong top line.
Definitely a strong start. Shows some real commercial traction, right?
Indeed. But then on the flip side, they missed on EPS.
That's right. And, quite significantly, they reported an adjusted net loss per share of -8 cents. That was wider than the consensus estimate of a 5-cent loss per share.
Right.
And the GAAP diluted net loss per share, that was even wider, a staggering -55 cents.
Wow. Yeah, that's a big number.
Yeah. And the market's immediate reaction was interesting, too. Shares of D-Wave, QBTS, they declined about 3% in pre-market trading right after the announcement.
Which makes sense, given that EPS miss.
Exactly. Analyst sentiment initially kind of characterized the results as mixed. They acknowledged the strong revenue, sure, but definitely noted that profitability miss.
Can't ignore that loss per share.
No kidding. So if we pull back and look at the performance summary, comparing Q2 2025 to Q2 2024, the numbers really highlight this mixed picture. Total revenue, like we said, jumped $2.18 million in Q2 24 to $3.1 million in Q2 25. That's a fantastic 41.8% year-over-year growth.
Solid growth there.
But then, prepare yourself for this. Their net loss just exploded. It went from about $17.8 million in Q2 24 to a massive $167.3 million in Q2 25.
Oof.
Yeah, that's an 841.2% year-over-year increase in loss. Just staggering.
That's such a huge jump.
And diluted EPS reflects this, right? -55 in Q2 25 compared to -10 in Q2 24. That's a 450% year-over-year increase in the loss per share. So this definitely paints a complex picture. Revenue up, losses exploding. How do you reconcile that apparent contradiction? So what does this all mean?
Right. And this is exactly where understanding earnings per share, EPS, becomes, absolutely crucial. For you, the listener, there are a couple of ways companies report this. Basic EPS is pretty straightforward. Net income or loss divided by the common shares outstanding right now.
Simple enough.
But then there's diluted EPS, and that's usually a more conservative, often more comprehensive measure. It adjusts the share count for the potential impact of all these dilutive securities.
Like what?
Well, think of things like employee stock options, convertible debt, or in D-Wave's case, a lot of outstanding warrants. It's like this. Basic EPS is your slice of the pizza as it is right now. Diluted EPS considers all the potential slices that could be cut if, say, options or warrants get exercised.
Okay. Got it.
So for a company like D-Wave, with all those warrants floating around, diluted EPS gives you a much more complete view of the potential claim on earnings for each share.
Okay, that makes sense.
Now, to get to the heart of your question, why the big divergence? Revenue up strongly, but net loss and diluted EPS way worse. It looks, contradictory. But the divergence isn't because their underlying business fell apart. Not at all.
Okay.
It's primarily the result of two significant interconnected factors. The first, and really the main driver of that huge net loss, was a $142 million non-cash, non-operating expense.
Okay, non-cash, meaning no actual money went out the door.
Exactly. It's an accounting thing.
Huh.
It was related to the change in fair value of warrant liabilities. Let me just unpack that a bit for you.
All right.
Warrants give holders the right to buy stock at a set price later, right? Now, here's the kicker. D-Wave's stock price went up a lot during the quarter, which is good news for the company. But because of that, the value of these outstanding warrants also increased on paper. And JAP, the accounting rules, basically say you have to record this increase in liability as an expense on the income statement, even though, like you said, no cash was actually paid out.
Huh. So it's an expense triggered by good news, essentially.
Precisely. It's like your house value goes way up. Great for you. But an accounting rule might say, well, your potential capital gains tax liability just went up, so we have to record that potential cost now. It's a paper expense tied to success, not a cash drain. And this single charge, that $142 million, accounts for the vast, vast majority of that reported net loss.
That explains a huge chunk of it. What was the second factor?
Right. Second, the company's aggressive capital raising, which we'll talk more about, led to a big increase in the number of shares outstanding. The weighted average diluted share count surged by 75.6%, went from about 172 million shares in Q2 '24 to over 302 million in Q2 '25.
Wow, that's a lot more shares. Dilution, right?
Exactly. Significant dilution. It means that the net loss, even if it had stayed the same, is now spread across way more shares, which naturally makes the per-share loss figure look worse.
So the combo of the big non-cash accounting charge and way more shares
Creates a kind of perfect storm for the GAAP EPS figure. Causes it to diverge really sharply from the positive operational revenue growth.
Yeah, okay.
So for you, the listener, this is likely why the market reacted negatively at first glance. Investors often see that headline EPS, miss and react.
Yeah.
They might miss the nuance, right? That for D-Wave, this gap loss was really an accounting consequence of the company's own success. The rising stock price boosting warrant values, not some, fundamental business problem.
That's a critical aha moment, really. Understanding why the numbers look the way they do.
Absolutely. Sometimes a big loss on paper is actually hiding something positive underneath. You have to look at what kind of expense it is.
Right. That definitely helps reconcile that gut reaction to the big loss number.
It's about looking through the gap number to the operations. Revenue growth tells you the core business is moving forward. This loss was technical accounting reacting to a rising stock.
Okay, that helps immensely. So now that we've got the headline picture and clarified that big accounting wrinkle, let's peel back another layer. Moving to slide 2. The engine of profitability.
Right.
Here, we're shifting focus beyond just the headlines to really look at D-Wave's ability to turn that revenue into actual profit. We're examining gross margins, operating expenses, and what the data seems to reveal is, well, a company with pretty stable core profitability that's consciously choosing to reinvest really heavily in growth, like prioritizing market leadership and tech advancement over, immediate profits or operating leverage.
Yeah, that's a good way to put it.
Yeah.
And to dive into that, let's start with gross profit and margin. Gross profit, just as a quick refresher for anyone, is the profit after you subtract the direct costs of making and delivering your products or services, your cost of revenue. So D-Wave's GAAP gross profit for Q2 was $2.2 million. That's up 42% from $1.4 million last year. What's impressive, actually, is that this 42% growth exactly matched their revenue growth.
Oh, interesting.
Yeah, so it resulted in a remarkably stable GAAP gross margin of 63.8%, just a tiny tick up from 63.6% last year. This stability is, well, strong signal, shows they controlled their direct costs well, even as revenue scaled up. Suggests, consistent pricing power, operational efficiency in their core stuff.
So they're not just selling more, they're selling it just as profitably at the gross level.
Essentially, yes. Now, they also report non-GAAP gross profit and margin. This just adjusts for non-cash things like stock-based compensation, depreciation. Their non-GAAP gross profit was up 39% year over year to $2.2 million. The non-GAAP gross margin was 71.8%. That was actually down slightly from 73.1% last year.
A slight dip there.
Yeah, slight. It's still very robust, but that little dip in this, let's say, cleaner metric could subtly suggest maybe a minor shift in their revenue mix towards stuff with slightly higher underlying costs. But overall, very strong margins for this kind of tech company.
Okay, so core business seems quite healthy then. good control over direct costs as they grow. What about their operating expenses? The R&D, sales, admin costs, are those growing in line too?
That's the next critical piece, right?
Yeah.
Operating expenses, the cost not directly tied to production but essential for running the show.
Mm,
D-Wave's total GAAP operating expenses grew 41% year over year, from $20.2 million to $28.5 million.
okay.
And their non-GAAP adjusted operating expenses, taking out those non-cash items again, grew 43% year over year, from $15.5 million to $22.2 million.
Wait, so 43% growth in OpEx and revenue grew 42%. They're almost identical.
Exactly. And what's fascinating here, or maybe just really telling, is that fact. Operating expenses grew at basically the same rate as revenue. This is a critical indicator. It shows D-Wave is not yet demonstrating operating leverage.
Right. Operating leverage is when revenue grows faster than costs, widening profit.
Precisely. And D-Wave isn't there yet. You can think of them as still being in that heavy build-out phase, right? Investing heavily in the future rather than banking big profits today.
So it's not inefficiency, it's a choice.
That's the key takeaway. It appears to be a very deliberate strategic choice. The press release even says the increase was driven by investments in people, fabrication, professional services, all to support the company's continued growth and expansion.
Makes sense for where they are. Quantum computing isn't exactly mature yet.
Not at all. For an early-stage company in a field like this, grabbing market share, pushing the tech roadmap forward, building a global presence, those are absolutely paramount. The spending pattern confirms they're prioritizing these long-term goals over near-term operating profits.
So for you, the listener, what does this mean going forward?
It means you should probably anticipate continued high reinvestment. The key thing to watch in future quarters will be when that revenue growth starts to sustainably outpace expense growth. That'll be the signal that these big strategic bets are starting to really pay off and scale, that operating leverage is finally kicking in.
That's a crucial distinction. Helps you look past the immediate numbers to the long-term game plan.
Yeah.
Like they're still building the factory, not yet running it at full profit capacity.
Exactly. Laying the foundation.
Okay, with that foundation in mind, let's pivot. Next up, slide 3, financial strength and shareholder rewards.
Okay.
So here we're looking at the health of D-Wave's balance sheet, how they're managing capital. And what's truly remarkable about Q2 25 is that it marked this, profound transformation in their financial posture.
It really did.
And for a growth stage tech company like D-Wave, capital management isn't about dividends, right? It's about raising cash to fuel that aggressive expansion.
Precisely. And the most significant development this quarter, without a doubt, was how dramatically they strengthened that balance sheet. They ended the period in their strongest financial position ever.
Wow.
Yeah. I mean, look at the numbers. June 30th, 2025. Cash and cash equivalents stood at a staggering $819.3 million.
800 million.
$819 million. Up from $178 million at the end of 2024. That's a 360% increase just in the first half of this year. And get this, compared to Q2 last year, when they had about $41 million, it's an astonishing 1903% increase.
That is quite a turnaround. Where did all that cash come from?
Well, it was a result of a really successful run of financing activities during the quarter. They raised $400 million through an at-the-market or ATM equity offering.
Okay, an ATM offering.
Yeah, it's basically a flexible way for a company to sell new shares gradually into the market over time at whatever the market price is. It's often used to capitalize on positive market sentiment without doing one huge, potentially disruptive offering.
Gotcha.
Then they also brought in $99.3 million in cash from warrants being exercised. Remember those warrants that caused the big non-cash expense?
Right. Now they're turning into actual cash for the company.
Exactly. And they got another $37.8 million net from their equity line of credit, or ELOC, basically a prearranged credit line based on their equity.
So a lot of equity-based financing. How does their debt look?
That's the other notable thing. Minimal debt burden. Total liabilities are about $149 million, while stockholders' equity is way up at $694 million. That gives them a really low debt-to-equity ratio of about 0.215. It shows a very strong equity-funded structure. They haven't loaded up on debt.
That's quite a war chest they've built, mostly through equity. So what does this mean for how they'll use that capital going forward?
Well, as you'd expect for a company at this stage, no mention of dividends or buybacks. That's not the game right now. The goal is funding growth. The CEO, Dr. Alan Barras, specifically said the proceeds are primarily for strategic acquisitions and general corporate purposes.
Strategic acquisitions. Interesting.
Yeah, it clearly signals they're now positioned not just to fund their own internal growth, building out quantum systems, expanding operations, but also to potentially buy complementary tech, or maybe even teams to speed things up and solidify their lead.
Okay, so for you, the listener, what's the big picture takeaway on this transformed balance sheet?
The transformation really can't be overstated. That $819 million in cash, it's truly a strategic weapon. It gives them a multi-year operational runway. It insulates them from capital market volatility, lets management focus purely on execution without constantly worrying about the next funding round.
Takes a lot of pressure off, I imagine.
Huge pressure off. And it massively reduces that going concern risk you sometimes see with speculative tech companies. It effectively turns D-Wave into a really well-capitalized industry leader. They have the resources now to pursue their ambitious goals for years.
That's a massive shift in their story. It really changes the risk profile. They've stocked the war chest, as you said. Okay, finally, let's turn our attention to the last piece. Slide 4. The road ahead management's outlook and key takeaways.
Right. Bringing it home.
This is where we synthesize all that quantitative stuff with management's qualitative story to get a forward look. And the outlook, well, as you might guess, given that balance sheet, sounds pretty confident, underpinned by milestones, commercial traction, and that huge cash position we just talked about.
Yeah, management's commentary definitely paints a picture of momentum. The CEO, Dr. Baratz, sounded quite confident. He said, our second quarter results show consistently strong performance across a multitude of technical and business metrics, and we're confident in our ability to continue delivering long-term value. The kind of bullish statement you'd expect.
But is there substance behind the confidence?
It seems so. They back it up by highlighting some concrete achievements in the report. First, on the tech side, they announced general availability of the Advantage2 quantum computer. That's their newest, most advanced system. A big deal in this space. Second, they're expanding the ecosystem. They released a new quantum AI and machine learning toolkit. The goal there is to make it easier for developers to get started, lower the barrier to entry.
Making it more accessible.
Right. Third, global expansion. They set up a new strategic relationship with Yonsei University in South Korea, even talking about a potential on-prem Advantage2 system there.
Expanding their footprint.
And critically, growing commercial adoption. They mentioned new and renewing customer deals with big global names: EON, GE Vernova, Nikon, NTT Docomo, Sharp Corporation.
Those are some serious players.
Exactly. These are tangible validations, shows the tech has real-world application and that the investments are turning into actual customer wins.
Those are impressive achievements, definitely adds weight to the confident outlook. Okay, so to bring it all together now, what are the key takeaways that synthesize this whole deep dive, connecting the market context, the financials, the outlook? All right, here's where it gets really interesting.
Okay, so for you, here are, I think, the 4 key takeaways that really bring it all into focus. First, that headline loss, it was deceptive. It masked a strong operational quarter. Remember, the initial negative reaction was tied to that EPS miss.
Driven by the warrants.
Driven overwhelmingly by that non-cash warrant charge. An accounting thing tied to a rising stock price, not a failing business. The underlying story was strength. That 42% revenue beat showed real customer demand and adoption.
Okay, takeaway 1, look past the headline loss.
Takeaway 2, their balance sheet transformed into a fortress. This is maybe the single most important outcome of the quarter. They raised a ton of cash, ending with that record $819 million.
The strategic weapon.
Exactly. It fundamentally de-risks their future, funds them for years, gives them that dry powder for R&D and maybe acquisitions, frees them up from market whims. They're absolutely playing the long game now.
Got it. Fortress balance sheet.
Third, their growth strategy is all about investment right now, not immediate profitability. The financials clearly show this high investment phase, right? OpEx growing with revenue means they're pumping every dollar back into tech, like Advantage2, the ecosystem, market expansion, customer wins.
Building the moat, as you said.
Right. They're accepting near-term losses as the necessary cost of building long-term value in this really early stage quantum industry.
Okay. Investing for the long haul. What's number 4?
And fourth, shareholder dilution was the necessary price for that fortified future. Let's be clear. The cost of building that fortress balance sheet was significant, that 75.6% jump in diluted shares. Dilution is a real cost to shareholders. Your slice gets smaller.
Sure.
But you have to weigh that against the huge strategic advantage and the much lower risk profile that comes with having all that cash. They essentially traded equity for a secure, well-funded future, ensured they can compete and innovate for years.
A strategic trade-off, then.
Absolutely. So In summary, D-Wave's Q225, it tells the story of a pivotal investment quarter. They successfully used their momentum to execute financings that transformed the balance sheet. That created complex, seemingly contradictory results, right?
Yeah, the revenue beat versus the EPS miss.
Exactly. The revenue beat shows tangible commercial success. The EPS miss and the dilution. Those are the direct, necessary consequences of the financing strategy that secured their future. They're not opposing stories, they're two sides of the same coin. So the quarter shouldn't be viewed just through that narrow lens of one accounting number. It's really about the successful execution of a plan to fund their next, more ambitious growth phase. And hopefully this structured approach helps you move beyond those headlines, see the drivers, assess the health, understand the outlook, and build a deeper understanding over time.
What an incredible deep dive into D-Wave's Q2. It truly shows how critical it is to look beyond just the surface numbers, doesn't it? And how accounting nuances can tell such a complex story.
They certainly can.
So maybe something for you to think about as you look at future earnings reports. What hidden fortresses or strategic investments might be masked by those immediate headlines? And, how long can a company like D-Wave keep up this kind of aggressive investment phase before it really translates into that significant operating leverage?
Good questions to keep in mind.
Thank you for joining us for this deep dive.
And just a reminder, this report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. The information here is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While we've made efforts to ensure accuracy, no guarantee is provided.
And also note, this report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data from real-time web searches. Although the AI is designed to follow strict data sourcing and verification protocols, errors or omissions might still occur. All information, including financial data and calculations, should be independently verified by you before making any decisions. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.